Let's start this conversation with him, not on the market wide, but just this thing. Manish, are a clutch of business models out there waiting to get disrupted because of AI, or will they adapt AI and still be on top of the game? Physics wala was the reason why we were having this conversation, by the way.
No, so the whole idea is that traditional business models will have to adapt to AI over a period of time. And in that context, many of the revenue streams which currently are available for these companies are no longer going to be available in the AI adaptation mode. So, yeah, I agree with you. The physics wala, etc., edtech as a whole, will have to, will get disrupted, so to speak. Another thing out here is basically customer acquisition cost. We have seen in many new gen companies, Nika, etc., when they came out with an IPO, the operating leverage playing out due to diminishing marketing costs does not really come through. And, the valuations, etc., get impacted because of that. So it all depends on execution on the top line, and which is a function of your scalability, ARPU, as well as your AI adoption. Correct.
Okay, so that's with regards to where the edtech space goes. Manish, good morning. Hiral on this side. Staying with the AI theme, what I want to ask you is the way your IT sector can be viewed as well, because we are breaking it up into various segments. You're talking about product-related companies. You're talking about service-related companies. H-1B visas could be concerns for your service-related companies as well. How would you look at all of these in 2026?
These services businesses don't fall off a cliff. And Indian IT is basically a service. So, the existing contracts or even the new contracts are going to get fructified, albeit at a lower pace. So yes, $1 lakh dollars visa fee is a cost escalation, plus the number of visas that you're going to give. All of that will translate to, again, adapting of the business model more towards offshoring, more hiring on site for local presence, and GCC is obviously eating into the market share of the traditional IT vendors. Coupled with that is basically your AI adoption. And I think over a period of time, Indian IT guys actually, adapt to new technologies, applications will get molded around the AI theme. We have already started seeing companies like TCS, HCL Tech report AI revenue separately. Vendor new deals or new client deals would come through in terms of efficiency gains on account of AI. Only moot point out here is that if you are going to hire lesser number of people, where is it that the pricing power comes to? Because at the end of the day, time and material, if it gets disrupted, that business model gets disrupted. It's more on account of outcome-based pricing. Then for efficiency gains, the software companies need to get compensated. So over a period of time, pricing is going to be a good metrics to look at as to how the traction is getting built around AI. But given the current backdrop, reporting AI revenues separately is a good thing. And 6% sort of a growth in the Indian IT space looks doable. Valuations have corrected, so, and plus rupee depreciation. So all in all, good place to be in the current context, I would believe.
Manish, hi, very good morning, and great to speak with you. I think if you look at broad themes for 2026, definitely AI and what it does to Indian IT will be one of them. But the recurring point that we hear from everyone is that the best is yet to come for the BFSI space, for bankings and financials. Even though you saw some boost from the GST cuts, etc. Do you believe in that as well? Do you have a similar opinion?
So look, in the broader context, government is incentivizing to borrow and spend. Income tax cut, GST cut, and if you are not compensated, there's not a commensurate increase in income, you can always leverage and spend. And because interest rates are very low, it is expected that credit growth in the system is going to go up. And that is the delta in the BFSI space because of the very recent rate cut that you saw. NBFCs are going to have a front loading of the cut in their borrowing cost, leading to expansion in margins. Banks will do that over a period of time through lowering of your deposit cost. So valuations, etc., are very, very reasonable in the BFSI space. Both the NBFCs and the banks. Even public sector banks, some of them are trading at very reasonable valuations. A case in point is that the volume of credit is going to go up, and margins over a period of time, we'll see the bottoming of margins for the entire BFI space, and valuations are very reasonable. Maybe the best is yet to come.
In calendar year 2026, the next 2 quarters, where and when in the cycle do you see that happening? And do you see then maybe your NBFCs kicking off more than perhaps the private banks, which have been the favorites?
So typically it takes around 6 to 9 months for the entire rate cut to get passed on, for the banks per se. For the NBFCs, the borrowing cost impact will be immediate. For the banks, the rate cuts linked to will be basically passed on in terms of lending cost when it is where it is repo related or repo connected, but the deposit cost will get passed on over a period of time. 6 to 9 months is the time frame. I think in the next 2 quarters and beginning fiscal 2027, if you believe that there is not going to be any further rate cut in February, or maybe the rate cut is going to happen in June, then broadly you are likely to see the bottoming out of margins by the fourth quarter of fiscal 26.
Okay, Manish, the other thing is buckets where you are really reasonably confident. Now, things are changing very fast, right? Just everybody was constructive autos, and suddenly the raw material prices are playing havoc with what could happen in Q3 margins. And that may alter the price of the stocks in the short term, even if the long term may look good. So I'm just wondering if your list of favorites has changed through the course of the quarter. Where is it that you're most constructive on as things stand for 2026, whether the first half or whether the whole year?
So consumption and primarily focused towards the premium end is not going to see any dent in demand because of rise in raw material cost or anything else. So premium end of the consumption, and whether it be catering to automobiles, jewelry, consumption goods, etc. Plus, where there is a brand salience which is still intact, and we through our research have really come to the conclusion that basically there are 4 categories or sectors where brand salience is very much intact. Maybe the other consumption categories, brand salience is getting diluted due to D2C. And which are these 4 categories? Consumption, basically automobiles, real estate, jewelry, and alcohol. Here people don't compromise on the brands per se, but consumer durables, FMCG, because of D2C, Mamaearth of the world, etc. Brand salience is getting diluted. So from that point of view, premium end of the consumption looks very good. We believe that Indian markets are going to be much better placed in calendar 26 vis-a-vis calendar 25, and so capital market is a theme. Valuations also are very reasonable out here given the growth. Everything related to capital market theme should do well. We are positive on rate sensitive, which is BFSI, the banks, the insurance, the real estates, the automobiles, autocoms, and you have a budget coming through. Today there were some media reports suggesting that PLI is going to get doubled in autocoms. All these spaces look very good. IT as a contraplay, and pharma, if you were to see selective positive news flows come through on the CDMO front. Nice. I think these would be the favored sectors currently.
That's a large bucket. Manish, I'm wanting to ask you one question because I'm sounding like a broken record when I'm asking people about the capital markets theme. But to you in particular, you have not shied away from betting on the micro caps as well in this bucket. Seemingly, you are very constructive here.
Yeah. I mean, see, I think the foreigners, particularly so in the wealth management space, where even the smaller companies, if they start early, because the foreigners have lost it in the wealth management space. You have all the wealth managers who are basically Indian guys, Indian companies, the Morgan Stanleys of the world, etc. They have vacated this space long time back. So I think the pie is very big. Over a period of time, you will require intermediation for your wealth management. More people are going to get affluent, and UHNIs are going to be in very large numbers. So, and these are very high operating leverage business. There's not too much of capital intensity out here. Only cost is people cost, and bulk of the cash flows come down to your bottom line, and you can pay dividends out of that. So, and these are very high entry barrier businesses because your captive clients, particularly so when you are talking to, let's say, 50 crore plus ticket size, they don't switch very easily. The 5 crore to 25 crores, etc., is basically a fungible client base which move. But otherwise, this space, the wealth management space, even the smaller ones, have a right to win in the long run, provided they stay the course. Don't throw in the towel, ups and downs, because these are fantastic businesses. Other businesses are also small caps, and the RTAs, the depositories, again, the 75 crore PAN accounts, only 21 crore demat accounts, long way to go. Profit pool getting shared between two players. Very little chance of a third player coming in now and making it big. So all in all, the economics of the game in the capital market space is defined in such a way that large pool is getting shared with a fewer number of players, and there's not too much of capital intensity, which makes it a perfect business model going into the long term.
Manish, come to the studios one of these days next year and let's do a show only on this theme, because you seem to have great insights here. So it'll be lovely to do that. But on that note, from all of us out here in the NDTV Profit team, Manish Sonthalia, to you and everybody at MK Investment Managers, a very happy new year.